Imagine waking up tomorrow, checking your bank account, and realizing the value of every dollar you own is quietly changing. Not because you spent it, not because you invested it, but because a small group of economists in a building in Washington decided it should. Most people think money is controlled by governments, but in the United States, the real control center sits inside an institution called the Federal Reserve System. And despite the name, it's not really federal. It's not really a reserve. And understanding how it works might completely change how you see the economy. Because the Federal Reserve doesn't just manage money. It quietly shapes the price of houses, the cost of your car loan, whether businesses hire or fire workers, and sometimes whether the entire financial system survives. But to understand why the Fed exists at all, you have to go back to a time when the American banking system was basically chaos. In the early 1900s, banks in the United States failed constantly. There was no safety net, no central authority controlling the money supply. If people lost confidence in a bank, they rushed to withdraw their money. And if enough people did that at the same time, the bank collapsed. One of the worst moments came during something called the Panic of 1907. Banks froze. Businesses failed. The stock market plunged. And the US government realized something uncomfortable. The world's largest economy had no system to stabilize itself. So in 1913, after years of political fights and economic panic, Congress created the Federal Reserve System. The idea sounded simple: create a central bank that could control money and step in during financial emergencies. But the structure they built was strange. The Fed isn't one building. It's actually a network. 12 regional Federal Reserve banks spread across the country, plus a central decision-making body in Washington called the Federal Reserve Board of Governors. And together, they run what might be the most powerful economic machine on Earth. But here's the strange part. The Fed doesn't control money the way most people imagine. It doesn't print stacks of dollars whenever it wants. Instead, it controls something much more subtle: the price of money. And that price has a name: interest rates. Think of interest rates like gravity for the economy. When rates are low, money becomes cheap to borrow. Businesses take loans. People buy houses. Investors pour money into stocks. Everything starts floating upward. But when rates rise, borrowing becomes expensive. Spending slows. Investments shrink. And the economy feels heavier. The Fed changes this gravity mainly through one critical number called the federal funds rate. This is the interest rate banks charge each other for overnight loans. It sounds obscure, but this single number quietly influences almost every financial price in the country. Mortgage rates, credit card interest, car loans, even stock market valuations. When the Fed raises this rate, it's like tightening a valve on the flow of money. When it cuts the rate, it opens the valve again. But here's where things get interesting. Changing interest rates is only the beginning. During crises, the Fed sometimes does something far more dramatic. It creates money, not with printing presses, but with computers. This process became famous after the 2008 global financial crisis. Banks were collapsing, credit markets froze, and the entire financial system was hours away from seizing up. So the Federal Reserve did something unprecedented. It started buying massive amounts of government bonds and financial assets. Trillions of dollars worth. The program had a technical name: quantitative easing. But in simple terms, The Fed was injecting brand new money into the financial system, and suddenly banks had liquidity again. Markets stabilized, the crisis slowed. But the side effects were strange, because when you flood the system with cheap money, that money doesn't always flow evenly. It often flows into assets first. Stocks, real estate, financial markets, which means policies designed to stabilize the economy can sometimes inflate asset prices at the same time. This is one reason the US stock market exploded upward for years after 2008, and then again after the pandemic. During the COVID-19 pandemic, the Fed unleashed the most aggressive intervention in its history. Interest rates dropped to nearly zero. Trillions more dollars were pumped into financial markets, and suddenly money became incredibly cheap. The economy recovered faster than many economists expected. But there was a catch, because when money becomes too cheap for too long, something else starts rising. Inflation. Prices across the entire economy begin climbing. Groceries, rent, energy, everything. And controlling inflation is supposed to be the Fed's most important job. The Federal Reserve actually has two official goals: stable prices and maximum employment. This is known as the Fed's dual mandate. But those two goals don't always get along. If the Fed raises interest rates to stop inflation, it can slow the economy and cause unemployment. If it cuts rates to boost jobs, inflation can spiral upward. So every decision the Fed makes is basically a trade-off, and sometimes those trade-offs become brutally clear. Take the early 1980s. Inflation in the United States had exploded into double digits. So the Fed chairman at the time, Paul Volcker, made a radical decision. He raised interest rates above 19%. The result was immediate. Inflation collapsed. But the economy plunged into a painful recession. Unemployment surged. Businesses failed. The cure worked, but it hurt, which reveals an uncomfortable truth about the Federal Reserve. Its job is not to make the economy comfortable. Its job is to keep the system stable, even if that stability sometimes requires short-term pain. And that's why every meeting of the Fed's Policy Committee, the Federal Open Market Committee, is watched obsessively by investors around the world, because a few sentences from the Fed can move trillions of dollars in global markets. Stocks jump, bond yields swing, currencies shift, all based on subtle signals about where interest rates might go next. It's a strange system. 12 regional banks, a handful of economists, a committee meeting 8 times a year. And somehow, their decisions ripple through every corner of the global economy. But here's the deeper irony. For all its power, the Federal Reserve doesn't fully control the economy. It can influence credit. It can steer financial conditions. But it can't control wars, supply chains, oil shocks, technology revolutions, or human psychology. Which means the Fed is constantly trying to steer one of the most complex systems ever created, using only a few blunt tools: interest rates, asset purchases, and communication. Sometimes it works brilliantly. Sometimes it creates new problems while solving old ones. And sometimes the consequences don't appear until years later. That's why debates about the Federal Reserve never really end. Some critics argue the Fed distorts markets and inflates bubbles. Others believe it's the only thing preventing financial chaos. Both arguments have evidence. Both arguments have history. And the truth probably sits somewhere uncomfortable in the middle, because modern economies have become so dependent on central banks that removing them might cause collapse, but relying on them too heavily may create risks no one fully understands. Which brings us back to the original question. The Federal Reserve controls the price of money. It influences inflation, employment, markets, and the stability of the financial system. But the real mystery is something else. If the entire economy depends on a small group of policymakers adjusting the cost of money, then the most important question isn't just how the Federal Reserve works. It's this: what happens if the system ever asks the Fed to solve a crisis that its tools were never designed to fix?